A man earning $200,000 a year just opened his banking app. The number on the screen is $847, and payday is 6 days away. He's not careless. He's not stupid. He's not addicted to anything visible. He's just discovered something that high earners across America are starting to realize quietly. A six-figure income doesn't buy freedom. It buys a larger cage with better paint. This video is about why the math of high income breaks down and what actually replaces it. According to the Bureau of Labor Statistics, in 2024, the average American household spent 33.4% of its budget on housing and another 17% on transportation. Together, more than half of average annual consumer expenditures before anything else gets decided. That ratio doesn't change much when you earn more. The categories just get more expensive. This isn't a story about discipline. It's a story about structure. Here's the paradox most personal finance content refuses to address. When income rises, expenses rise with it. But they don't rise the same way. They rise as commitments. Rent becomes a mortgage. A used car becomes a financed one. A small health plan becomes a family premium. The Kaiser Family Foundation reports that in 2025, the average total family health insurance premium, employer plus worker combined, hit $26,993, a 6% jump in 1 year, well above inflation and faster than wages. Now layer on top of that. A New York Fed report shows total U.S. household debt reached $18.8 trillion in early 2026. That's the structural picture. Now let's break down why the high earner is the most exposed person in it. 4 mechanisms, each one a layer of the trap. And by the end of this video, you'll understand why earning more rarely solves the problem, and what actually does. Let's start with the one nobody warns you about. Couple gets a promotion. Combined, they're now earning $240,000. The first thing they do? Trade in the old Honda for an SUV. $600 a month. The second thing they do? Move to a bigger house in a better school district. Mortgage jumps from $2,100 to $3,800 a month. Now multiply that by 12 months every year forever because none of those payments are going down. This is the fixed cost ratchet. It moves in one direction only. A ratchet, in mechanics, is a tool that turns one way and locks against the other. Apply that to spending. Every upgrade locks in. Reversing feels physically wrong. This isn't a guess. It's a documented pattern in consumer economics. Duesenberry called it the ratchet effect back in 1949, and behavioral research has confirmed it ever since. The psychological mechanism is hedonic adaptation. You get used to the upgrade in weeks. The payment lasts for years. Layered on top, a concept Richard Thaler called mental accounting. The brain doesn't see a mortgage as a choice anymore. It files it under obligation. Renegotiating it feels almost taboo. The raise didn't disappear. It just moved in. And here's the part almost nobody catches. The higher your bracket, the more taxes scale up too. By the time the paycheck hits the account, the discretionary portion is sometimes smaller than it was at a lower salary. They look at their balance and think, where did it all go? And here's the part that gets under the skin. The house is nice. The car runs. The kids are fed. By every visible measure, life is working. Which is exactly why the feeling of being broke makes no sense to them. You can be earning more than you ever imagined and still feel like the floor could give out next month. The exit from this trap is not a budget. It's structural. Every quarter, remove one fixed cost from the system. One. That's the only way the ratchet runs in reverse. And it has to be deliberate because the system will not do it for you. That's mechanism 1. Now let's talk about why leaving the job becomes impossible. A senior engineer at a tech company. Salary, $180,000. Bonus structure, another $60,000. Equity grants worth $200,000 more. Vesting over 4 years. She's been there 2.5 years. Half her equity has vested. The other half, $80,000 of it, won't vest for another 18 months. She hates her manager. Her work has stagnated. She's been wanting to leave for a year, but she can't. Because leaving means walking away from $80,000 of already promised compensation. This is the golden handcuffs mechanism. The reward you've already earned becomes the cage that keeps you in place. Bureau of Labor Statistics data confirms the structural pattern. Higher paid, longer tenure workers quit at lower rates than lower earners. And SEC filings show that equity-based compensation has grown substantially at senior levels over the past 2 decades. 2 psychological mechanisms compound the financial one. First, status quo bias, documented by Samuelson and Zeckhauser in 1988. People prefer the current situation when leaving means giving up accumulated rewards. Second, loss aversion. Kahneman and Tversky's prospect theory shows that losing $80,000 hurts roughly twice as much as gaining $80,000 feels good. So the calculus isn't even close. Staying feels neutral. Leaving feels like robbery, even when the robbery is just the cost of being free. You're not staying because you love it. You're staying because leaving costs more than you have. And this is the part that wears people down quietly. The job stops being a choice. It becomes a payment plan you're making with your own time. You stop talking about leaving. You stop browsing other roles. You start measuring the years until vesting like a prison sentence with a release date. 18 months becomes the number that runs your life. The number you'd never let anyone else use to define you. The way out of this one isn't quitting in a rage. It's running the math honestly. Add up the real cost of leaving, unvested compensation, healthcare bridge, severance you'd give up. Then add up the real cost of staying, the year of your life, the career flatline, the next promotion you won't get. The handcuffs aren't actually as heavy as they feel. They're just made of a metal your brain treats as gold. That's mechanism 2. The third one is more subtle, and it explains why high earners often feel poorer than people with half their income. A homeowner, 42 years old. House, market value $700,000. Mortgage, $300,000 remaining. Retirement accounts, $200,000. On paper, his net worth is $600,000. In his checking account, right now, $2,847. This is phantom wealth. The number on the balance sheet doesn't match the number you can actually spend. Net worth measures what you own. Liquidity measures what you can use. They are not the same number. The Federal Reserve Survey of Consumer Finances shows that for most middle and upper middle income families, home equity is the single largest component of net worth. Between 2019 and 2022, median household net worth jumped sharply. But that growth was concentrated in illiquid assets, homes and retirement accounts, not in cash that pays bills. Fed flow of funds data confirms it. Most American household wealth sits in equities and real estate, volatile, illiquid in the short term. Here's why this matters psychologically. Economists call it the wealth effect. When the value of your home or your portfolio rises, you feel richer, even though you can't actually spend any of it without selling. And the feeling drives behavior. People spend more, save less, and take on more debt when they think they're wealthy on paper. But that wealth doesn't pay for a car repair. It doesn't cover a medical bill. It doesn't fund 3 months of unemployment. Net worth is what you own. Liquidity is what you can actually use. They are not the same number. And this is where the disconnect starts to feel personal. Everything around you tells you you've made it. Then you swipe a card for $50 in gas and something tightens in your chest. And you can't explain why. The numbers say rich. The body knows fragile. And the body is more honest about this than the spreadsheet. There's a more useful question than what's my net worth? It's how many months could I cover without selling anything if income stopped today? The exit from phantom wealth is building a liquidity floor, 3 to 6 months of expenses in cash. Boring, slow, ugly. And the most underrated wealth strategy nobody talks about. That's mechanism 3. Now we get to the part most finance content avoids, because it implies that the standard advice doesn't work. You've heard the standard advice. Earn more. Invest the difference. Time will compound the rest. But here's what almost nobody points out. If your fixed costs scale with your income, earning more doesn't change the equation. It just makes both sides of it bigger. The mathematician Franco Modigliani showed that what determines wealth accumulation isn't the level of income. It's the percentage of income that doesn't get spent. Savings rate is the variable that matters. Not income, not return. The percentage you keep. And here's the asymmetry that breaks the standard advice. Cutting fixed costs is more powerful than raising income, dollar for dollar. $1,000 a month is $300,000 in capital. Do the math before you do anything else. Here's the math. Cut $1,000 from your monthly fixed costs. That's $12,000 a year you no longer need. Divide by 4% the safe withdrawal rate from retirement planning research. And the answer is $300,000. That's how much capital you no longer need to accumulate. Cutting $1,000 of fixed cost saves you the equivalent of $300,000 of capital. A $10,000 raise at 25% savings is worth around $2,500 a year. 12 years of that raise to match one cost cut. 12 years versus one decision. The treadmill doesn't have a speed setting that gets you off it. It has an off switch. And the moment you understand that, something heavy lifts. The pressure to earn more, the next promotion, the side hustle, the burnout you've been calling ambition, starts to loosen. Because the math finally changes shape. You're not chasing a moving target. You're closing the gap from the other side. And the off switch is structural, not motivational. You don't beat lifestyle inflation by trying harder. You beat it by changing what your money is committed to. Behavioral economists Richard Thaler and Shlomo Benartzi designed a program called Save More Tomorrow in 2004. The idea: automate the direction of every future raise. Before you see it, before your lifestyle adjusts, the increase gets routed into savings and investment. Inertia, the same force that traps you in lifestyle creep, can work in reverse. Once it's set up, it runs itself. That's the structural exit, not motivation, not budgeting harder, a change in where the next dollar is committed before you ever see it. Now, the honest counterpoint, because every structural argument has a limit, and it would be lazy to pretend this one doesn't. Not every high earner is trapped. Some structure their fixed costs deliberately, max retirement contributions, hold large liquid buffers, and avoid the ratchet entirely. The pattern is real, but it's not universal. The trap is structural, but structure can be designed against. And golden handcuffs aren't always as restrictive as they look. Some equity compensation is liquid, hedgeable, or transferable to a competitor offering a sign-on bonus. Phantom wealth has exceptions too. Some high-net-worth households maintain large liquid positions deliberately. Others borrow against assets at low rates without selling. The point isn't that high income is bad. It's that high income alone doesn't solve the problem most people assume it solves. The variable that matters is the structure around the income, not the size of the paycheck. For interventions, for mechanisms, each one structural, none of them about willpower. The shift starts here. Pick one mechanism. Just one. Not all four. Not a master plan. One mechanism, one quarter, one decision that actually changes the structure. This quarter, audit one fixed cost. Insurance. Subscription bundle. Mortgage refi check. Pick one and remove it from the system. Next paycheck or next raise. Set up an automatic transfer that routes the increase into investment before it ever touches checking. And start building the liquidity floor. Not perfect. Not all at once. One paycheck at a time until 3 months of expenses sit in cash. Don't try to do all four at once. The trap was built one decision at a time. The exit gets built the same way. And nothing about this requires earning more. That's the part that catches people off guard. The lever was never on the income side of the equation. A book worth reading on this, Your Money or Your Life, frames money as life energy and walks through the structural changes that make the math work. This video uses affiliate links, and there's one in the description if you want to check it out. It's a slow read, but it's a serious one, and it explains the structural math better than most modern content does. Back to the man from the beginning. $200,000 a year. $847 in checking. He's not waiting for a raise. He's not blaming himself. He's listing the 4 structural levers. The trap was never about discipline. It was about a system that scales obligation faster than it scales freedom. One quarter, one mechanism, one fixed cost at a time. The treadmill doesn't stop on its own. You don't out-earn a structural trap. You restructure your way out of it. The math gets simpler the second you stop chasing the income number and start managing the obligation number underneath it. High income doesn't buy freedom, but high income with low fixed cost, that does the math nobody else tries to teach. A six-figure income is not freedom. A low-cost structure is. The paycheck never set you free. Your obligations decide whether it ever could. That's mechanism 4. That's the trap. That's the exit. See you in the next one.